If you and your partner have worked really hard all your life, slogged 80 plus hours a week in demanding jobs, and by the time you're in your 30s, you have been able to make some decent savings of over $100,000, what is the best way for you to invest your hard-earned money? Stocks or income properties? Which one suits millennials better? My name is Alki Wong and I'm a mortgage broker. Previously, I worked in investment banking and management consultancy. And around a year back, I asked myself this exact same question. After a lot of research and learning from my own experience, I think I finally have found my answer, and today I'm gonna share that with you. A study shows that income property has shown an 11.7% annual return for a single-family home between 2001 to 2021. This is conservative as the study has assumed 35% down payment instead of the usual 20%. With a lower down payment, that means more leverage, and the return could be even better. Also, plexus and multifamily home with more tenants generally yield more than single-family homes. The stock benchmark S&P 500 averaged a 9.7% annual return in the past 20 years, with dividend reinvested, making income properties likely more lucrative, at least in the US. In Canada, it's harder to say as you have to refinance your mortgage every 5 years, but it's probably not too different. Return is very important, but remember there are other factors to consider as well when you're deciding which investment is the most suitable for you. Stocks are more liquid than real estate. Unlike stocks, you cannot buy real estate in your app at the snap of your finger. In theory, stocks require almost no active management compared to rental properties. That said, if you want to trade stocks profitably, the research is very time-consuming. A hassle-free approach would be to buy an index ETF like the S&P 500 in the US or the S&P TSX 60 in Canada instead of the individual stocks. Buy ETFs worth a fixed amount, say $500 a month, and hold your investment for a really long time. In this way, you don't have to worry about timing the market, as a long enough horizon will almost always balance out the short-term movements. If you use this approach, then yes, stock market investing is more passive than income properties. Residential real estate is more stable in nature and prices do not fluctuate as much as stocks. This implies a lower short-term risk. In financial terms, real estate offers a better risk-weighted returns. There is also a well-known supply shortage of houses in Canada and the US. The home development projects are just not able to keep up with the population growth. This demand-supply arbitrage makes a strong case why residential real estate prices might continue increasing in the next 10 to 15 years. The single biggest advantage of a real estate investor is leverage. But what is leverage? Imagine you invest in a property worth $300,000. You put 60 from your pocket and the remaining 240 using a bank mortgage. Assuming the rent that you earned can cover your mortgage and any other expenses, you will have no additional cost on this property going forward. Now, fast forward 3 years. You sell the property for $500K and voila, you just made a profit of $200,000. So what just happened here? You put 60K of your own money and use 240K from the bank to make this profit. But you get to keep the entire $200,000 to yourself. Simple, right? Well, not so simple. I oversimplified a lot of the calculations, like maintenance, repair, closing costs, and taxes. But you still get the overall concept. In a way, leverage is a secret sauce in real estate. Also, remember leverage is a double-edged sword. If your house price started dropping like it did during the 2008 financial crisis, leverage might magnify your losses as well. In stocks, most people do not use leverage as it is a really risky game. And those that do, they must be professional traders. Stocks are more liquid and hence the price fluctuates way more. The golden rule of investing is diversification. Don't put all of your eggs in the same basket. Now, chances are very high that your pension plan like 401k in the US or RRSP and TFSA in Canada is indirectly tied to stocks. Big asset management firms like BlackRock typically invest large pension funds in stocks and bonds, giving you a taste of those asset classes. Now, if you want to diversify, it could be worth considering income properties with your personal savings. But here's the catch. Make sure it's money you won't be needing in the short term, because real estate is not very liquid. So yes, in conclusion, in terms of risk-rated returns, income properties clearly steal the show. But it comes with some hustles as well. If you have the right process in place and a good property management software, these hustles can be dealt with fairly simply. But if that sounds too much of work, then disciplined investment in index fund is also a good way to build wealth over long run. So which option suits you better? Write in the comments below. Professor Lucci? Stocks or income property? Oh, immediately, what is that?